Welcome to our annual State of the Markets presentation. We're delighted you're joining us today. Now let's take a look at our disclosures here, and while you're reading through these, I'll remind you that you can view DMI's information on our website, www.dmi.solutions, and also follow us on social media.
Today we're going to look at four key areas. We're going to talk about past performance, current situations, and forecasts for 2022. Now, let's begin by looking at Wall Street's analysts' initial predictions for market performance in 2021, how stocks actually performed, and some of the factors that drove performance.
With multiple COVID-19 vaccines announced in the latter part of 2020, Wall Street analysts were cautiously optimistic about 2021. While the U.S. wasn't out of the woods at that time, there were a number of reasons to be hopeful for a strong economic recovery, including multiple vaccines to stem the spread of infections, fiscal support, monetary accommodations, and a budding reopening. As you can see from the actual results, the markets performed better than even the most bullish analysts could have predicted. For instance, JP Morgan was the most optimistic of the analysts on the list, calling for about a 20% increase from the 2020 closing levels. Even that prediction ended up underestimating where the markets closed out for 2021. Let's talk about the factors that led to this.
After a bumpy start to the year due to slow vaccine rollout and political uncertainty, the market climbed steadily higher throughout the year with a succession of better than expected quarterly corporate profit results and rebound in economic activity. However, the climb was not without its hiccups. The third quarter, with accelerating inflation numbers and worries over the Fed's tapering plans, led to short-lived pullbacks.
So what happened in 2021? As the chart shows, you see a steady move higher throughout 2021, except for some periodic dips. The worst of which was a retreat in September as concerns about the economy and Fed policy peaked. Without going through each of these dates, let's look at a few noteworthy points. As you can see, the market was choppy during the first quarter of 2021, but take a look at mid-March, where the U.S. crossed the mark at 100 million vaccinated Americans. At this point, the sense was beginning to grow that the nation had overcome the fits and starts in our vaccination rollout. Investors began to feel more comfortable that the country was finally getting to a place where the economy could sustain its growth momentum. There were scares throughout 2021. Look at the middle of July and more broadly the month of September. The one-day slide in July and the nearly 1 month retreat in September were largely attributable to COVID-19 related events. We saw the stock market resume its climb in October based on the strength of strong corporate earnings and a decline in COVID cases and an upbeat report from the Fed. Markets turned volatile into the close of the year, slumping on the news of the Omicron variant the day after Thanksgiving and testimony by Fed Chair Powell that he was considering accelerating the bond taper and contemplating more rate hikes sooner than anticipated. Higher inflation and an improved labor market were cited as reasons to justify accelerating monetary normalization. The market closed out the year with the Fed announcing some decisive steps on monetary policy that very likely will impact the markets into 2022, which we'll discuss in more detail later in this presentation. Despite the pivot toward a less accommodative monetary policy, stocks climbed higher into the year end as Omicron fears receded a bit.
Corporate earnings are one of the primary determinants of stock prices over the long term. As the chart indicates, corporate profits came roaring back from their 2020 pandemic levels, lifting investor sentiment. Earnings soared in the second quarter of 2021, posting a 25% year-over-year jump in corporate profits. However, third quarter profits may have been more impressive since the 17% growth in earnings was during a new wave of Omicron variant infections. Investors were especially impressed that the spike in infection cases did not diminish consumer demand and that companies were able to maintain their profit margins amid rising inflation and supply chain issues. The economy staged a strong rebound in the first half of the year as evidenced by successive increases in GDP. However, growth moderated in the third quarter despite growing bottlenecks in the supply chain. While many observers anticipated re-acceleration of GDP expansion in the fourth quarter, continuing supply chain problems may prove to be a drag. Labor markets were slow to benefit from the economic reopening in the first half of the year, but as you can see, unemployment rate dropped sharply by the end of the third quarter. As we entered the last 3 months of the year, the labor outlook continued to improve with job openings exceeding the number of unemployed and robust wage growth. Inflation developed as a real concern as the year progressed, rising from a modest 2.6% in March to 5.4% in September, with October and November 12-month inflation rates setting even a higher bar. We'll examine this development a little bit further in depth later on. Consumer sentiment was on an upward trajectory as American consumers felt better about the economic reopening. The fourth quarter number is an actual sentiment reading for November and reflects a continued downward slope in consumer outlook due to the rising inflation and the perception that policies haven't been put in place to arrest the rise in prices. Finally, home builders' optimism was especially high in 21, not surprising given the low interest rate environment and continued consumer demand for homes amid the pandemic. The number indicated is a survey of single-family home builders, their view of current conditions, and their 6-month outlooks, scoring on the basis of 0 to 100. You can see how their optimism was high throughout the year, notwithstanding a dip in the third quarter, owing to that quarter's resurgence in COVID cases.
So we've looked at some of the factors affecting market performance in 2021. Now let's look at where we are now and examine the headwinds and tailwinds that could affect market performance in 2022. To create some context about where we stand today on various factors, let's start by examining where we stood just before the pandemic began. After a stretch of good economic performance, conditions in February 2020 were mixed, though still positive. You can see a number of positive indicators, including monetary policy, consumer spending, interest rates, and perhaps notably, inflation and energy. There were some cautionary signs about the future, such as the economic outlook, equity valuations, leading economic indicators, and corporate profit growth. The only two factors of concern were geopolitical risks and the domestic political environment at that time.
Now let's fast forward to November of 2020. By then, we appeared to be beyond the worst days of the economic lockdowns and COVID cases. The overall outlook was cautious. While monetary policy, inflation, corporate profit growth, and leading economic indicators were trending positive, there were more cautionary signals, most significantly in consumer spending, energy costs, business sentiment, labor market weakness. There was also double the number of negative indicators from February, most notably equity valuations and disposable personal income. Now, let's review what those economic and financial indicators tell us about today's current economic state. As you can see, 17 of the 20 indicators are green, which suggests that the economy and markets are in a good position for 2022. Only 3 are flashing some warning signals, such as equity market valuations. After the run-up in values of 2021, this shouldn't be much of a surprise. There are no outright negative indicators here.
Let's delve a little deeper into one of those speedometers, the leading economic index. This includes 10 components ranging from stock prices to manufacturing orders. When examined together, this data may give a clear view of where we are. Leading economic indicators suggest that economic expansion is trending higher into 2022, though supply chain bottlenecks cannot be overlooked as a factor that may frustrate this outlook. As you can see, a rise in the index of leading economic indicators has never been followed by a recession, so that's encouraging. However, no model is flawless, especially with COVID still hanging over global economies. It's important to remind people that past performance does not guarantee future results. As we review charts like these, history can help suggest where we are in the economic cycle. It's also important to remember that forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations as you see in the forecast. From the leading economic indicators and the economic speedometers, we just saw that the economic outlook is positive for 2022. However, the economy and the financial markets will have to withstand some potential headwinds to meet these optimistic expectations. The first headwind may be the emergence of Omicron, the latest variant of the COVID-19 virus, along with the resurgence of the Delta variant. While few expect the sort of economic shutdown that accompanied the 2020 pandemic, Given the progress of vaccinations, any moves to restrict social contact may adversely impact economic growth, similar to the Delta variant surge last year. Inflation remains a big challenge for the economy, as higher prices may sap consumer spending power and consumer confidence. We will take a deeper dive into inflation implications for the market later in this presentation. At the end of last year, the Fed announced that it would be quickening the pace of its wind down of its monthly bond purchases, signaling that as many as 3 rate hikes might follow in 2022. The Fed's policies may have been a major factor in driving stock prices. However, the Fed is looking to return to a more normalized monetary policy amid a healthy economy, a rebounding labor market, and accelerating inflation. It's uncertain how investors will react once supports are removed and interest rates move higher. We saw an example of this at the beginning of the year. Think back to January when the minutes from the Fed's December FOMC meeting indicated their rate hike might come sooner than expected, which led to a sharp market sell-off. One result of higher rates may be a reevaluation of stock prices to reflect higher interest rates. However, if the Fed finds itself behind the curve in fighting inflation, it may be forced to use its monetary brakes, which could adversely impact markets. As 2021 came to a close, there were early indications of slowing economic growth in China, in large part due to its zero COVID policy that shut down whole cities at the first report of infections. As its wealth has grown, China has become an increasingly larger importer of foreign goods and raw materials. Any reduction in demand will be a drag on a wide range of companies globally. The midterm elections also create a degree of uncertainty. The markets will be looking to see if there is a shift in congressional power and what that may mean for future economic policies. Finally, geopolitical tensions are always a potential headwind. Tensions in countries bordering Russia, China's threats towards Taiwan, and Russia's leverage over Europe's energy supply are just some examples of where tensions may flare.
The economy is expected to expand in 2022. The level at which economic growth serves to propel its markets higher, of course, will be a function of how healthy that growth is. Though the Fed is reducing its monthly bond purchases, they're not likely expected to begin that till June or July this year. The takeaway here is that monetary policy remains quite accommodative despite these early steps towards normalization. Corporate profits were solid in 2021. As mentioned earlier, one of the primary determinants of stock prices over the long term is its corporate earnings. Provided earnings continue to expand in 2022, this may justify current valuations and serve as a catalyst for higher prices. Also, the consumer appears healthy, as net worth has grown from pre-pandemic levels. Financially strong consumers should continue to support further consumer demand for goods and services. That said, there is one important caveat to this tailwind. Consumer confidence is actually at a cycle low owing to the sharp and continued rise of inflation. Watching the cost of basic consumer goods like food and energy take up an increasing amount of personal budgets is not only psychological dispiriting, but it could also reduce the amount of discretionary income consumers have at their disposal. There is another side to what inflation may do to consumer spending. Inflation may increase spending in the short term, since behavioral experience suggests that consumers frequently choose to buy today if they believe prices will be higher tomorrow. Despite this kernel of uncertainty regarding the consumer, we expect that consumers will be a net positive force for propelling economic expansion. Before we move on to our discussion of 2022 forecasts, let's examine this chart to see where stock prices are trending against historical averages. The most common way to do this is to look at the PE ratio, or price to earnings ratio, which measures what investors are willing to pay for a company's earnings. If you look at the dotted line in the middle, you can see that the PE ratio for the past 25 years on average is 16.8. You can also see that the PE moves around quite a bit, with a peak during the dot-com boom and a trough during the credit crisis. As of October 21, the PE was 21.4, which is higher than its 25-year average would suggest. It may bear mentioning that the big technology stocks, which because of their growth prospects typically sport higher PEs, represent a greater proportion of the S&P 500 than ever. So it's a comparison to the past that may have limited value. These higher valuations may be in line considering the current low interest rate environment.
We've talked about what impacted the markets over 2021 and what may impact the markets in 2022. Now let's see what the experts have to say and where they think the market is headed in the context of a more detailed discussion of some of the possible headwinds and tailwinds we were just reviewing. We mentioned that a healthy consumer might be a tailwind for the market this year. Here's why we think that this could be the case. The share of GDP that comes from spending from within the U.S. is just a shade under 70%, which makes the financial health of the American consumer integral to economic growth. This chart is an illustration of Americans' balance sheets coming into the new year. As you can see, assets owned by individuals have steadily risen since the depths of the pandemic in the second quarter of 2020. To a level that is now higher than pre-pandemic levels. Meanwhile, consumer debt has stayed roughly the same through the same period, owing in part to governmental assistance programs throughout the pandemic period. When taken together, Americans' net worth has increased, which has put more spending power into the hands of consumers, which may lead to higher economic activity. There's one other important element to increase spending. However, besides having the money to spend, confidence about the future. In the past 2 years, we have seen that consumers who lack confidence in the near-term health of the economy or are concerned about the spread of COVID infections are less likely to spend. Consumer confidence took a hit as 2021 came to a close, thanks to the Delta surge, accelerating inflation, and the introduction of the Omicron variant.
Corporate earnings will likely be another important determinant of the stock market performance in 2022. After all, this is a key factor in determining valuations in the long run. Overall, earnings in 21 were strong, rebounding strongly from muted earnings during the pandemic months in 2020. As you can see from the chart, the third quarter was exceptionally strong, increasing 39.8%. Fourth quarter earnings in 2021 were expected to be over 20%. And these big numbers are not likely to be repeated. In fact, earnings growth estimates are expected to narrow with the 2022 calendar year growth rate of just under 9%. At first glance, that might seem like a headwind rather than a tailwind for the markets. But remember, markets are discounting mechanisms that look 6 to 9 months ahead. Today's prices reflect the 2022 forecast for its corporate earnings growth. However, a strong economy in 22 could lay the foundation for positive earnings surprises in 2022. It's important to remember that forecasts or forward-looking statements are based on assumptions that could be revised without notice or may not even materialize. And if we've learned anything from the past couple of years, it's that the outlook for the financial markets can change quickly. Inflation is a very important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little inflation can be a sign of economic weakness. As this chart suggests, inflation took a sharp turn higher last year from the norms of recent decades. The strong rebound from the pandemic-induced recession, coupled with labor market shortages and supply chain bottlenecks, caused the prices of many goods and services to jump. Some economists also point to the combination of fiscal spending and accommodative monetary policy as contributing factors to the acceleration of inflation. Whatever the reason, inflation has accelerated at a faster pace and persisted for much longer than originally anticipated by the Federal Reserve. Fed Chair Powell has admitted as much. Despite this admission, Powell still believes inflation will recede in 2022, and the market has largely accepted this inflation narrative. While unclogging a supply chain will be a key development in 22 to moderate inflation, wage growth pressures are likely to persist as a driver of continued inflation this year. We also included the rise in producer prices because they can indicate future increases in consumer prices, since businesses often pass on some or all of their price increases to the consumer. Inflation may have a significant influence on the performance of financial markets in 22, since it could force the Fed to quicken its pace of the bond tapering program and change its plans for interest rates. In each instance, the Fed's actions may impact bond yields and stock prices. Even if the Fed sticks to its schedule for tapering and interest rate hikes, the bond market may not sit idly by. Bond investors may demand higher yields to offset rising inflation, the effects of which could ripple into the stock market, especially among high valuation companies.
During the past 2 years, there has been no greater influence on the stock market during the short term than, you guessed it, COVID-19. Increases in infections raise the prospect of economic restrictions, causing temporary sell-offs, while declines in infections or new treatments buoy investor sentiment. While the emergence of Omicron and the prospect of an uptick of new infections, investors will be particularly sensitive to how well this risk is managed. As this chart indicates, we've seen defined surges of infections, the initial one in 2020 and that of the Delta variant in the third quarter of 2021. Of course, no one can predict the course of COVID-19 infections moving forward. We have seen that markets get nervous when they spike. Economic forecasters surveyed by the Philadelphia Fed are painting a generally improving economy. While they have trimmed their GDP growth estimates for the final quarter of 2021 and the first quarter of 2022, they are projecting stronger growth by the second half of 2022 than originally anticipated. On the labor front, they are very optimistic, calling for declining unemployment rates throughout the year and at a much faster pace than they had predicted earlier.
The labor market continued to strengthen over the course of 2021, with unemployment following and wage growth accelerating. As we saw in the previous slide, unemployment is expected to fall further as the economy expands. A healthy employment picture has historically augured well for the economy. While wage growth is generally a positive development for the economy, it should be noted that this upswing in wages has been offset by a far faster rise in prices, leaving many workers with lower spending power despite strong wage growth. So, what are experts forecasting for domestic equities in 2022? On average, they are expecting a modest gain from the 2021 close, as the forecast reflects the belief that stocks are unlikely to repeat their outsized gains of 2021, as well as some headwinds that may impact corporate earnings and economic growth, such as inflation, supply chain issues, and possible COVID-19 variants. Within this average forecast for the modest returns is a broad range of estimates, from a flat or slight decline to a much healthier gain. Of course, no one knows for sure what equities will do in 2022, and predictions at this stage are just that, predictions. However, these analysts' perspectives show that, for the most part, Wall Street is guardedly optimistic. Like other images in this presentation, this image includes a forecast, so it's important to remember that all forecasts are based on assumptions and are subject to revisions over time. Financial, economic, political, regulatory, and in this instance, health issues may cause the actual results to vary from expectations.
We've covered a lot of information, focusing most of our discussion on what drove the market and what we expect to move the market over a short period. However, as we know, what sometimes can get lost with a short-term focus on the market is a consideration for the long term. This chart illustrates the value of investment discipline. Since 1950, we can see that the one-year range of returns for stocks is quite wide, with yearly gains of up to 47% and yearly losses of up to 39%. As represented by the purple bar, bonds have a much narrower performance, ranging from a positive 43% to a negative 8%. Finally, we see a hypothetical balanced portfolio of 50% stocks and 50% bonds, in which there are lower highs and higher lows. If we follow the performance of these three portfolios during the 5, 10, and 20-year rolling periods since 1950, we see that the range of returns narrows. In short, a balanced portfolio can help manage overall risk. The precise allocation among different asset classes will vary from one investor to another, depending upon their individual goals, time horizon, and risk tolerance. Asset allocation is approached to help manage investment risk. Asset allocation does not guarantee against investment loss. In this illustration, stocks are represented by the S&P 500 Composite Index, which is an unmanaged index that is considered representative of the overall U.S. stock market. Bonds are represented by the Strategist Ibbotson Index from the periods from 1950 to 2010 and the Bloomberg Aggregate Index from 2010 to 2020.
So what can you do in 2022 to move closer to your goals? Here's some ideas. First of all, keep us in the loop. There's going to be changes like births, deaths, and family events. We also care about your health issues, important employment changes, and financial developments that might impact your situation. If you're thinking about new goals or reevaluating old priorities, share your thoughts with us so we can help you pursue the life that you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like a shift in your risk tolerance or any concerns about the market environment. Finally, remember to go over your estate documents, beneficiary designations, and other paperwork to make sure that they're all up to date. A well-organized estate is one of the best gifts that you can give to your family. We're here to talk through whatever financial concerns or questions you may have. Our priority is always to help you make informed choices and stay on track.
Thank you so much for your time today. As you can tell, we are passionate about helping you understand the markets and learning facts amidst the hype. For more information and timely updates, please follow us on social media. Keep up with our website, dmi.solutions. We hope you have enjoyed the details we shared today. Thanks again.